Welcome for everyone listening today. My name is Oliver Vélez, and today we're going to be presenting a presentation that I call the 5-Minute Trader. More specifically, how to earn a living in the first 20 minutes of the trading day or so. And I do want to make sure that I'm coming through okay. So can you verify that? Am I audible? Is my sound okay?
Yeah, I think it's everything okay, Oliver.
Okay, fantastic.
The feedback is positive, so you can keep it.
Fantastic.
Your presentation.
Excellent, thank you. 2 weeks ago, we had a wonderful presentation that I hope you found helpful, based on one of the #1 approaches or tactics in the market called the almighty breakout. I hope you took for those of you who attended that event, I hope you took the last 2 weeks to really focus on that technique, because it is one of the key components to many of our traders' success in the States. Today's presentation is going to focus on an approach that really deals with the first 15 or 20 to 30 minutes of the trading day. And before we delve into the heart of the material, I do want to mention to you that many of our traders focus on 2 dominant parts of the day. The first 90 minutes of trading, the first 1 hour and 1/2 of trading, and the last 90 minutes of trading, or the first 1 hour and a half of trading, the last 1 hour and a half of trading. And the middle of the day is often traded very, very lightly or not traded at all. And what we have found is that the greatest degree of certainty, the greatest degree of volatility, which is a very, very big friend for active market participants, the best odds actually exist in the first part of the day and the last part of the day. The middle of the day represents the sloppiest part of the day, and the part of the day that typically displays or enjoys the least amount of follow-through. In other words, the least amount of odds of success. And we have found that if traders really spend the vast majority of their time in the first part of the day and the last part of the day, or either or, they statistically do better than traders that trade through the entire day. And I don't know if many of you have experienced this, but a lot of traders come out of the blocks in the morning, do well in the first part of the day. As they continue to trade, they start to dismantle or undo their success in the middle of the day, and maybe come back a little bit from their losses at the end of the day. And if that's been your cycle, it is largely due to the fact the middle part of the day does, in almost all markets worldwide, the middle part of the day offers the least amount of follow-through, and as a result, the least amount of odds of success. So this presentation focuses primarily on that first part of the day, that first 20 to 30 minutes of trading. And what I'd like to do as to kick off the material is to talk to you about what I consider to be the 3 most powerful bars, or the 3 most powerful candles, I should say. Our approach is a very, very technical one. We pay very, very little attention to the fundamentals, or we pay very little attention to the things that would actually try to answer the question, why? We deal with things that answer the question, what? Okay? In our opinion, the what question is far more important than the why question. There can be many reasons why an individual sells, but what is most important is selling. There can be many reasons that individuals or organizations buy a stock, but to us, what's most important is the buying, not why the buying is occurring. What's most important to us is the selling, not why the selling is happening. To us, to make money in the markets, why is not necessary. What is extraordinarily necessary? All right? And for the purpose of this presentation, there are a variety of time frames that can be used to try to capture instantaneous money in the first 20 or 30 minutes of trading in the markets. But we find that the 5-minute time frame, the 5-minute chart where every bar represents 5 minutes of trading, is the ideal time frame to focus on for short-term oriented trading. And especially the 5-minute time frame is perfect for the tactic that I'm about to talk to you today, which is focused on deriving profitability in the first 20 or 30 minutes of the trading day. Okay, so we will start off with the 3 most powerful 5-minute bars. The 3 bars, the only 3 bars that you need concern yourself with in the first part of the day, or the only 3 bars you need concern yourself in the first 5 minutes of the trading day. All right? And these 3 bars are divided into 2 broad categories. All right? This is going to be somewhat of a review for those of you who listen to the other presentation, my other presentations, but repetition does have a certain value here. The 3 most powerful bars fall into, or in this case, in reality, we have 4 bars, 4 bullish bars and 4 bearish bars. But the 3 or 4 most powerful bars fall into 2 broad categories. We call them elephant bars, which are represented by the first group of bars here, elephant bars. And the second group of powerful bars are what we call tail bars. All right, and there's the bullish versions and the bearish versions. Tail bars and elephant bars are the 2 groups that make up the 3 or 4 most powerful bars, or the most important bars that the market can potentially form. Now, very quickly, let me just explain. Elephant bars are, by definition, very, very long, wide range bars that have a lot of color, more color in the bar than most of the bars that have appeared in, let's say, the last 20 or 30 bars to the left of the bar. So whenever we get a tall green bar that possesses or has more green in that bar than, on average, most of the bars that have formed over the past month or so, we have, by definition, a bull elephant bar. If we have a bar that has more red in it, that is longer, taller, and has more red than most of the bars that have appeared to the left of it, we can, by definition, say we have a bear elephant bar. So elephant bars are elongated, very long, wide range, thick colored bars that stand out as being taller and bigger and grander than most of the bars that have appeared in recent history. Now, what's interesting about elephant bars is that you cannot, in a very, very well-traded stock, I'm not talking about stocks that trade very thinly and have very little institutional following. No, I'm talking about stocks like, in the American market, IBM and Microsoft and Ford and Home Depot, things that have large institutional followings, things that are largely in the S&P 100, let's say, things that are not traded sparsely or scarcely. When you're dealing in that world, all right, that it is very, very difficult for a stock to produce a bull elephant bar or a bear elephant bar unless almost all of the institutional players in that particular stock act on that day, on that very same day, in the same way and with the same power. Now let's talk about this a little bit, because this is the crux behind the entire method here. A stock cannot form, as an example, a stock cannot form a bull elephant bar unless the vast majority of the institutions that are playing that stock all of a sudden decide to buy at the same time, on the same day, with the same force. Now think about this for a moment. If we assume that all of the institutions that play a stock have equal dollars, now we know that's not true, but for the sake of simplicity, let's assume this. All of the institutions that play a specific stock have the same amount of money to deploy in this stock. And let's say the number of institutions are 10. So 10 key institutions play this stock with the same amount of money. Now, if 5 of those institutions are buying and 5 of those institutions are selling, there exists what we call equilibrium in the market. So in a scenario where all the institutions are equal, if 5 institutions are buying and 5 are selling, it is impossible for the market to produce elephant bars if there's an equal amount of buying and an equal amount of selling. In fact, in that type of environment, the bars are going to consistently be very small, very narrow in form. However, if in our example, of the 5 traders, of the 5 institutions that are buying, and of the 5 institutions are selling, if 3 of the sellers stop selling, and now you have a scenario where 5 institutions are buying and only 2 institutions are selling in equal amounts, the green bars that form will start to become larger on average than the red bars that form in your chart. So another way of saying this is that your up bars are going to be larger. The footprints of the bulls are going to be bigger and larger than the footprints of the bears. So whether your charting system uses red for down or green for up or white for up or black for down, doesn't really matter. We're talking about up bars versus down bars. And in a scenario where 5 of the institutions are buying and only 2 of the institutions now are selling, your up bars are going to be taller and longer and bigger on average than your down bars. But get this, understand this. If all of the sellers stop selling, and not only if we formerly had 5 buyers and 5 institutional sellers of equal power and equal money, there's equilibrium in the markets. If 5 of the sellers stop selling, all of a sudden your up bars would become more powerful, longer, and bigger and more substantial than your down bars. But get this, if not only the sellers stop selling, but the 5 sellers that stop selling also join the buyers, and now instead of only having 5 buyers, you now have 10 buyers and no sellers, you start to produce elephant bars. Elephant bars are the footprints in the market that basically tell us this is a moment in time. If you see an elephant bar, this is a moment in time where virtually all of the institutions agreed on the same day, at the same time, in the same amounts. And that's a very, very significant moment in the market. You don't get it extraordinarily frequently, but you get it enough for it to be something for us to identify and exploit. So bull elephant bars in well-traded stocks can only form if there exists what I call institutional agreement if you have a series of very, 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 very small bars, you have institutional equilibrium, relatively equal buyers, relatively equal sellers. But bull elephant bars can only mean one thing in a well-traded stock. Institutions are agreeing on the same time, on the same side. Now, tail bars represent this second category of key bars to focus on, key candles to focus on. These come in a variety of different, basically come in three different varieties. You have green bottoming tail bars, you have red bottoming tail bars, and you have no color bottoming tail bars. And of course, the same goes for the reverse at the bottom. But let's focus on the buy side, or the bullish side. You can have a bottoming tail bar that has a green top, or a bottoming tail bar that has a red top, or a bottoming tail bar that has a no color top. And these are your three different variations of a bottoming tail bar. But I want you to understand that what a bottoming tail bar used to be, for instance, is a, if I can draw this in, bottoming tail bars used to be bear elephant bars. Let's see if I can throw this in, guys. Just give me just a second here. That's not going to work. Bottoming tail bars used to be bear elephant bars. They used to be very negative bars that actually moved to the downside initially. Here's a bar that initially dropped to the downside. And at its low, it was actually this bar, a very, very negative bar. Okay? All of a sudden, during the bar's time frame, there was almost a 100, almost, not quite, but almost a 100-degree reversal, or a major reversal that reversed the vast majority of the bar's range. So initially the bar was negative. On bottoming tail bars, initially the bar is negative. And that's very, very important to understand. Initially, the bar is negative. Okay? In just a second. Okay? Initially, the bar is negative, but the bulls or the buyers come back so strong and so furiously that they start to eradicate or eliminate the red, leaving behind a bottoming tail that represents where the stock used to be on the downside. And there's a general guideline that you should be very, very aware of in the market. You always give the benefit of the doubt to the group that was in control last. So there are two movements here. The first movement is down. The last movement is up. You give the benefit to the group or the movement that happened most recently, which is up in the bottoming tail bar. So bottoming tail bars are bullish in nature and mean that we should actually bet our money in favor of the last group in control, which is the bulls. The bulls reversed all of the initial red, the initial move down, and almost all of the red has disappeared. Now, in the case of the green bar, all of the red actually becomes gets erased and it becomes green. So in the green bottoming tail, not only is all the red erased, but the stock continues to move forward to produce the opposite color green. The point I want you to understand is that in bottoming tail bars, the bulls are reversing in a very, very big way. The bulls are reversing in a very, very big way in initial weakness. And they're doing it in style. They're doing it with power. And this is typically bullish. Okay? So you have elephant bars, which are bullish in nature, and you have bottoming tail bars, which are bullish in nature. And we're going to focus primarily on the bullish side of things for the sake of simplicity in this presentation. And so in reality, you have three types of bottoming tail bars, and you do have different variations of elephant bars, but now you know the two groups of bars that mean the most in the market. Any other type of bar or candle that is formed by the market is very, very, very small in terms of importance. I'm not going to say that the other bars have zero importance. What I am going to say is that their importance is so small that it's really not worth focusing on. These are the only 4 bullish bars you need worry about in the markets. And I'm going to demonstrate that for you. And hopefully you can verify this for yourself as you understand this concept and then take it into the market to gain experiential knowledge with it. Okay? So with that being said, let's talk about our 5-minute sell strategy. And once you understand the strategy, we'll go to individual examples to look at the play in action. So the first 5-minute setup criteria, this is the market opens and you're focused on the first 5-minute bar. We're looking at a 5-minute chart where every bar represents 5 minutes of trading, and you're intently watching the first 5-minute bar form. And here's the criteria. The first 5-minute bar of the general market must be one of these 3 or 4 bars. Now understand what I'm saying here. We're talking right now about the overall general market. So in the US market, the overall general market is like the S&P 500 or the Dow Jones 30 industrial average or the NASDAQ 100. So those are your 3 key market gauges: the S&P 500, the Dow Jones 30, the Dow Jones Industrial Average, which consists of 30 stocks, and the NASDAQ 100. In your market, whatever market you trade, you must watch whatever represents the broad market as a whole. All right, your key index I'm talking about. So the criteria is watching the key index in the 5-minute time frame. You're looking for the first 5-minute chart, the first 5-minute bar of the overall market. You're looking for it to form one of these 4 bars. When the overall market forms one of these 4 bars, either a bull elephant bar or one of the 3 bottoming tail bars, a green, a red, or no color, we are in business. Then you want the first 5-minute bar of an individual stock. You're looking for a stock that has a first 5-minute bar that looks similar to identical to the first 5-minute bar of the market. So we're looking for something close to a match. So let me give you an example of how we do this in the US market. We monitor, let's say, the S&P 100 and the NASDAQ 100. But let's, for the sake of simplicity, let's focus on the S&P 500 or the S&P 100, okay? The S&P 100 index has formed a bull elephant bar in the first 5 minutes of trading. So the first 5 minutes of the S&P 100, the first 5-minute period looks like this, a bull elephant bar. It's a solid, long green bar. What we're looking for at the same time is any stock in the S&P 100 that also has its first 5-minute bar that looks like a solid bull elephant bar. So we're looking for a match. We want stocks in the index that look almost, it doesn't have to be exact, but looks almost identical to the first 5-minute bar of the overall index, the overall market. And what you'll find on any given day is that there'll typically be 5 or so stocks that look identical to the overall index in the first 5 minutes of trading. If the first 5 minutes of trading in your overall market produces a bottoming tail bar, and let's assume that the first 5 minutes of trading produces a no color bottoming tail bar, then I'm looking for any individual stock in that index that also looks very, very close to a no color bottoming tail bar. And let me tell you this, when I talk about this concept of matching, a lot of traders say, well, Oliver, isn't that very difficult to find matches? Isn't it very difficult to find stocks that in the first 5 minute bar looks almost identical to the first 5-minute bar of the overall market? And my answer is always shocks the traders who ask this question. The answer is no, it's not very rare, or it's not very difficult to find. In fact, it's very easy to find. Your problem is not going to be finding how many stocks how many stocks in the first 5 minutes of trading look like the first 5 minutes of trading of the overall market. That's not your problem. The problem is going to be narrowing down the ones you find. If you think about it, the overall market looks a certain way because the vast majority of stocks that make up that market look a certain way. The overall index does not have a nature of its own. It's made up of the individual stocks in that index. So if the overall index has a bottoming tail bar with relatively no color, then a good many stocks that make up that index look like a bottoming tail bar with virtually no color. But we're looking for the match, because even on days where you have bottoming tail bars or elephant bars in your overall index, you're going to have many stocks, or a good many stocks, that actually are down versus up. So those we don't worry about. We focus on the matches, and we focus on the stocks that look the closest or the most identical in the first 5 minutes charts to the overall market. In essence, we're looking for twins, or the closest we can get to twins. Sometimes you just don't get pure twins. All right, so that's the first part of the criteria. We're matching stocks in the first 5 minutes of the trading that look almost identical to their parent index. Once we have this in play, here's the action criteria. If both 5-minute bars in the overall market or index and the individual stock are, I'm showing the sell strategy. All right, I'm showing the sell strategy here, but we really should be talking about the buy strategy. But if both 5-minute bars are bearish, let's say the first 5-minute bar in your overall market is a bear elephant bar, a solid red bar, and you have found 2 or 3 stocks in the same index that has the first 5-minute bar almost identical solid red bear elephant bars, we're going to short 1 tick below the first 5-minute bar whenever that occurs. So after the first 5 minutes of trading is complete, at any time in the very, very near future, if the low of the first 5-minute bar is violated, that becomes a short. Now, if you can, for me, let's reverse this to the buy side and make this a buy strategy, okay? If the first 5-minute bar of your overall market is bullish, it's one of the 4 bars we talked about, right? So if both 5-minute bars are bullish, either they are an elephant bars or tail bars, we're going to look to buy the stock one tick above, okay, the high of the first 5-minute bar. So what we're looking for is a match, and then we're looking for the stock. We're looking for a bullish match of the market and the individual stock, and then we're looking for the individual stock to trade higher than the high of the first 5 minutes of trading, whenever that occurs. Now, when I explain this, some traders just assume that that's going to happen in the very next bar, the second 5-minute bar. But that's not necessarily the case. Sometimes the high of the first 5 minutes of trading happens 3 bars later or 5 bars later. And sometimes the break above the high of the first 5-minute bullish bar never happens. So the point I'm trying to make is that you're going to buy into the bar that actually trades higher than the high of the first 5 minutes of trading whenever that happens. 1 bar later, 3 bars later, 5 bars later, 8 bars later, it really doesn't matter. Whenever it happens. Once that happens, we're going to place a stop 1 tick below, continuing with our buy, below the low of the first 5-minute bar. So we're buying a break above the first 5-minute high and placing a stop just below the 5-minute low. Then we're going to move our stop to break even after a 2-bar advance. Listen to this. Once we have bought above the high of the first 5-minute bar, we're going to immediately place our stop just under the first 5-minute low. This guarantees that all losses will be restricted to 1 bar. But whenever we win, we're going to win 8 bars or 5 bars or 13 bars or 44 bars or 20 bars. The object is to win many, many more bars than we risk. Your risk will always be 1 5-minute bar. But I guarantee you when you win, on average, you'll win multiple 5-minute bars. Many, many, many 5-minute bars. And this is the way to stay in this business for a very long time. This is tweaking or adjusting the odds in your favor, making sure that you lose on average 1 bar and win on average many bars. And this approach forces you to do that. So once we buy above the high of the first 5-minute bar and immediately place a stop under the low of the first 5-minute bar, we're going to move our stop to break even after a 2-bar advance. So in essence, if we're talking about 5-minute periods, we're looking for a minimum of 10 minutes to the upside. So we want 2 consecutive, it doesn't even have to be consecutive actually. We want 2 bars that trade higher than our entry price. Not 1 bar. We want 2 bars that trade higher. So if I've bought at $20.10 above the high of the first 5-minute bar, and my and the following bar trades up to $20.45. That's one bar up. And then another bar trades up to $20.60. That's the second up bar. Now that I have two bars that have pushed me into profitable territory, not one bar that's pushed me, but two bars. Now I have the right to adjust my stop to the break-even point. Where did I buy it? That's my stop. Once we have the right to move our stop from the low of the first 5-minute bar to the break-even point, we are now playing with the house's money. That's a famous term in the United States. When do I get to play with the house's money? We're not playing with our money. Initially, we're playing with our money because if the stop is violated under the first 5-minute bar's low, we can lose our own money. But when we move the stop to break even, we're not losing our money. We're playing with the house's money at that particular point. But remember, we want this 2 bars of profitability filter. What I found is this, in my 25 years of trading, that traders make a very, very big mistake of adjusting their stop too quickly, which forces them to eliminate potentially winning trades before they've matured, before they've even had a chance to demonstrate that they're worthy to be held. So this 2-bar filter, 2 5-minute bars, they don't have to be consecutive. So you can have one bar that pushes you into profitable territory, another bar that settles down, and 3 bars later, the second bar pushes you into profitable territory. They don't have to be back to back. But once you get 2 bars that push you consecutively higher into profitable territory, then and only then do you have a right to move to break even. And at that point, you're playing with the market's money. Step 4, take profits on any multi-bar rally. So what I tell my traders is think Fibonacci numbers. Think 3, 5. If your stock has given you 3 5-minute bars to 5 5-minute bars up in a row, take some profits off the table. What many of my traders do is after a 3 to 5 consecutive move up from their entry price, they will sell 1/2 of their position and they will keep the other half on with that break-even stop. Remember, once you have the break-even stop, you are not at risk to lose money, or at least to lose substantial money. There might be a little slippage, but you're basically break even. So take some off the table after a 3 to 5 consecutive bar run, take half off the table, and let's see if the other half can become a grand slam, a home run, a very, 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 very big winner. Remember, on that second half, we're not risking our money. So it's okay to just give it room and let's see how far it goes. Now, I hope you're following me at this point. Are there any questions on this at this particular point? Any questions before we start delving into some of the examples?
Oliver, I wrote you a question in the chat. I sent you a private message.
Okay.
We had a question there. If you could check it, please.
Okay, the question is, what about dojis? What concern do you have about that? Well, dojis represent equilibrium, right? Doji represents a bar where the open and the close are the same. So when the open and the close are the same, there is no agreement. There's no institutional moving in one direction or the other. There's confusion in the market. There's uncertainty. This type of first 5-minute period represents an uncertain time to play this strategy. We only want to play this strategy when it's certain that the institutional crowd, the beginning of the market, is moving almost entirely in one direction. There's greater certainty in one direction. Now that doesn't mean that the market can't reverse. That often happens. That's why we have stops. If markets never reverse, we wouldn't need stops. So we have protective stops for the times that the market immediately changes its mind, but we're looking for that first 5 minutes where things are so one-sided that the odds suggest that everything's going to continue in that same direction for quite some time, for 20, 30, 40 minutes, maybe even hours. You're going to be amazed at how this works. That when you match up the overall market's first 5-minute period with the individual stocks that look almost the same, how this concept of follow-through is going to reward you. There's often follow-through after a strong or weak 5-minute first period. Not always, but often. Often enough to just go with the first 5-minute direction. If the first 5 minutes is an elephant bar, odds are there's more upside. If the first 5 minutes is a strong bottoming tail bar, the odds are there's more upside. If the first 5 minutes is a bear elephant bar, the odds are there's more downside. If the first 5 minutes is one of the very strong topping tail bars, the odds are it's more downside. Follow through is the best concept to bet on after the first 5 minutes of trading. Now understand, it's not 100%. Nothing's going to be 100%. That's why we have stops. But you're going to be right far more often than you're wrong. And when you're wrong, you're going to be wrong small, 1 bar. But when you're right, this stock's going to run 20 minutes, 30 minutes, 45 minutes, an hour, sometimes hours. Okay? So dojis are not the bars we want to play. Does this apply to Forex market as well? Yes and no. You have to play this when remember, the Forex doesn't have a traditional open like the equity markets does in a way. It does have several opens, but not in the traditional sense that the equity market does, where everybody starts trading at the open. In the Forex market, there are various opens. There's an open when Japan opens for trading. That's an open. Then there's an open when London starts trading. Then there's an open when the US starts trading the Forex market. So there are a variety of opens, and if you use this concept in those key moments, those first 5 minutes or so, and you can actually do this on the Forex market. I find that going up a time frame is better. The first 15 minutes of trading, okay, is better. And sometimes even higher, the first 30 minutes, the first 30-minute bar. This has some leeway. This, you can adjust a little bit, especially in the equity market. I mean, especially in the Forex market. What we have found in the equity markets, the 5-minute time frame works best with this tactic or approach. And especially if you're looking for almost immediate profitability. Some days you're not going to get it, but on many days you will. Some days you might get stopped out. The market starts off strong and then reverses. 10 minutes later. All right, that's just part of the game. But on many occasions, there's going to be what I call follow through. This is Sir Isaac Newton said, an object in motion has a tendency to continue in that same direction or same motion. An object in motion continues in motion. So in essence, more times than not, you're going to get follow through with this. Now, let's take a look at this slide here. Does that also work with economic data as being released at the open of the market? Yes, economic data can be the driver of this, can be the driver of your elephant bar in the first 5 minutes of trading, or the driver of your strong bottoming tail bar. But I don't want you focused on that. I want you focused on the bar. Don't focus on why there's an elephant bar. Don't focus on why there's a strong bottoming tail bar. Just focus on the elephant bar, the bottoming tail bar. See, when you start to focus on the why instead of the what do I have? An elephant bar. What do I have? A strong bottoming tail bar. Why do I have it? Now we move into the ether. Now you can just might as well sit down with a bunch of talking heads and just you can debate all day as to why. No one can debate what, though. That's a big, fat, green bar. No one can debate that. That's a bigger green bar than I've seen in a long time. No one can debate that. Wow, look at that long tail, strong tail on that first 5 minute bar. No one can debate that. But why? Now we can sit down, light a cigar, and talk for hours. I don't want you to fall for that. I don't want you to get involved with that. Focus on what, not why. And oftentimes, you determine why after you've collected your profit. Okay? So, let's take a look at this. You are, in this case, criteria one is, here's the market's first, the overall market's first 5 minute bar. Let's say it's one of these bars, a bottoming tail bar. And then you find a stock that has one of the 4 powerful bars as well. Here's a stock that has a 5 minute bull elephant bar. Now, this to me is a match. As long as you have one of the 4 bars, it's a match to me. You don't have to be specific and match elephant to elephant or bottoming tail bar to bottoming tail. Oh, the market has a bottoming tail bar. Now I need to look for stocks only with bottoming tail bars. No. You just need to find a stock. You need the market to have one of the 4 bars, and you need your stock to have one of the 4 bars. That's a match. I hope this is clear. It's not tit for tat, tail for tail, or elephant for elephant. It's market has one of the 4, stock has one of the 4. Okay, I'm buying once the stock trades above the first 5 minute high. Now look at my example here. I'm showing, here's the first 5 minutes of trading. Here's the high of the first 5 minutes of trading. And in this case, the second 5 minute bar trades above the high. I'm buying once the stock trades above the high of the first 5 minute bar, and I'm placing my stop just under the first 5 minutes of trading. So my risk is always primarily just a little bit more than 1 bar. Okay? This break above the high could happen 3 bars later, 2 bars later, 8 bars later. It does not have to happen back to back. Okay, that's very important. All right, we're going. The same goes for reverse, guys, but I'm not going to focus on the sell side. You should be able to work in your mind the absolute opposite, okay? We're not going to delve in a lot of time here. So as an example, here's a 5 minute chart of the S&P 500, SPY, S&P 500. And what you're looking at is, here's the beginning of a day. Here's the first 5 minutes of trading of a single day. That's a bull elephant bar. Do you see that? That's a bull elephant bar that continued or had follow through for almost the entire morning. 5 minutes, 10 minutes, 15 minutes, 20 minutes, 30 minutes, 40 minutes, 50 minutes, 60 minutes. That's 1 hour. 5 minutes, 10 minutes, 20 minutes. There's almost 2 hours of almost relentless rise after the first 5 minutes of trading. Okay? Here's the first 5 minutes of trading of the 7th day 7th of whatever month this is. And here you have almost 5, 10, 15, 20, 25, almost 30 minutes of not exactly pure movement to the downside, but pretty much straight down movement. Remember, our traders use this 5-minute, I'm going to buy above the first 5-minute bullish bar, or I'm going to short below the first 5-minute bullish bar, bearish bar, as long as my market's bearish too, or as long as my market's bullish too. Okay? And this tendency to follow through is very, 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 very powerful. Okay? And here is a 5-minute chart of the NASDAQ 100. Here you have, look at this day, first 5 minutes of trading, and then you have 5-minute bar after 5-minute bar, almost gradually to the upside. Okay? And the same, I've grabbed the same days to demonstrate for you. Here's the first 5 minutes of trading, which is down. Now I'm looking for any stock in the NASDAQ that also has one of these bars, a bearish elephant bar or one of the topping tail bars, red one, green one, or no color. And if I find a stock that has, on a bearish market, first 5 minutes of trading, if I find a stock that has one of the 4 bearish bars, I'm golden. And I just short below the first 5-minute low. Now, let's take a look at individual stocks here. These are the overall market. Here is a 5-minute chart of a stock called Walmart. I'm sure you have Walmarts in your area. On the 8th, now look at the 8th for me, okay, of the overall market. On the 8th, the first 5-minute bar is one of our 4 bars, right? It's a solid, fat, long bull elephant bar. And all we're looking to do, if this is an elephant bar or a bottoming tail bar, we know we have to buy once the stock trades above the high. Once we buy into the stock above the high of the first 5 minutes of trading, we immediately put a protective stop right under the low. Now, sometimes that first 5-minute bar is going to be too long for comfort to place your stop under the low. In that case, we go 55% down. This is called the 55% alternative stop. So think about halfway and just a little bit more, okay? So go halfway down the green, go halfway down the green. Watch this, guys. Yes, go halfway down the green. It's about half. And just drop it a little bit lower. And use a 55% alternative stop if that green bar or if that bottoming tail bar during the first 5 minutes is too long for comfort to put your stop down here. So your stop is either under the low or at the 55% retracement mark, give or take. You do not have to be exact with this. I don't want you becoming scientists or geometrists. Oh, let me get my right angle ruler out and judge. Let me find out where exactly. Let me get my calculator out and find out exactly where the 55%. No. That's not necessary. It's a general area. And remember, after 2 bars of profitability, here's the first bar profitability. Your buy bar, remember, we bought the second bar. We bought into the second 5-minute bar as soon as it crosses the high. But that first bar that you buy could end you in profitable territory. If your first 5 minute, if the second 5-minute bar that you bought winds up closing higher than you bought it, that's profitable bar number 1. Okay? Does that make sense? Profitable bar number 1 is my buy bar. Profitable bar number 2 depends. You have to make a judgment here. If it's a little tiny bit, you can call that even. We want pretty much clearly additional profits, not, wait a minute, I'm profitable an extra 5 cents. No. I want that second profitable bar to be in earnest, to be like, wow, I'm up 2 bars now, not I'm kind of up 1 bar with some change in the other bar, with some pennies in the other bar. No, 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 no. 2 nicely profitable bars. And once you get that, your stop that was under the low can now get moved to break even. And it is at this point that you can sit back and relax, pop a soda, and just smile as the market now has to work for you. All right? And there are other things like trailing stops with your moving average and bar by bar trailing stop method. We're not going to get into that. It'll take us too long. So I want to focus on the core points of the 5-minute tactic. But understand that I want you to understand how to get your stop and when to move your stop to break even. If you understand that, I guarantee you, you will start making money with this. If you learn how to identify elephant bars and bottoming tail bars in the first 5 minutes of trading when the market has either an elephant bar or a tail bar, then you know how to trade, buy into any stock that has an identical or similar bar, one of the 4 bars, and buy above the high of the first 5-minute bar with a stop under the first 5-minute low. If you know how and when to move that initial stop, which is below your entry price initially, to the break-even point, you are going to turn this into a major moneymaker. Sometimes you'll get stopped out and lose at the low of your first 5-minute bar, but many times you're going to take a profit. Sometimes you're going to get stopped out at your break-even point, but many times you're going to take a profit. I have a trader who averages $8,000 US a day in the first 10 or 15 minutes of trading day. That's not the rest of his trading day, which he grows the amount on most occasions. Sometimes he undoes it. It's natural. But in most of the occasion, he grows the 8,000 average per day on other tactics and things of that nature which we teach. But with this tactic, he averages $8,000 a day in the first 10 or 15 minutes of trading. We're playing market strength and stock strength. All the winds are in the same direction. There's no wind moving to the east and another wind moving to the west. They're all moving to the east. All rivers are pointing in the same direction. All power is pointing in the same direction. And even if you mess it up a little bit, even if you make a mistake or two, because you're playing with the current, with the power, with the flow, the power, the current, the flow will sweep you and your small mistakes in the right direction. The problem we have as market players is fighting the flow, fighting the current. This is where most traders get into trouble. All right? Are there any other questions as we move forward in some of the directions?
No, everything okay. You can keep
going. We're good. This is actually not a 5-minute chart. This is a mistake. This is a 15-minute chart, I believe. And this goes to show you that at times you can move the time frame up if you like. If you're uncomfortable with the tiny time frame, in Forex, I would recommend the 15-minute time frame or the 30-minute. Because currencies trend longer, you can go up in time frame. Okay? We're buying once the first 5 minutes of the trading gets traded above, we're immediately placing our stop under the low. If that low is a little bit too uncomfortable for us, we can go first find where halfway is, and then just drop it a little bit more than halfway. Boom, 55%. And you'll find that many stocks rarely kind of reverse the first 5-minute directional move if the market's backing it up. Okay? Rarely. Now here are real 5-minute examples. Let's take a look. Let's take a look at a few. I'm showing mostly shorts. I'm going to show mostly shorts, and I'm almost going to apologize about that because I do sort of like to teach mostly from the long side and trust that people know how to reverse it for shorts. The reason why I focused on shorts is because this presentation is a presentation that we do to many of our 4,000 traders periodically. And professional traders do tend to short a lot more than they go long, even in up markets. Why is that? Statistically speaking, stocks drop faster and go further to the downside in a short period of time than they do to the up period of time. You could still be in a bull market, but when and you'll find that stocks in the overall market churn higher. It works to go higher. It struggles to get higher day by day. But when they drop, it's fluid, it's sharp, it's almost seamless. It's like, wow. So drops are faster, more furious, harder, longer. And so the short side statistically is more profitable than the long side for active individual traders. Now, I want you to assume that the overall market, and let's call the overall market the S&P 100. The S&P 100 has a 5-minute bar that looks like a bear elephant bar. And you have found an individual stock in that same index that has almost an identical 5-minute bar, first 5-minute bar. Now you simply wait to see if that stock violates the low of the first 5-minute period. At the time that it does, you are going to go short. You're going to immediately place your stop 1 penny or so above the high of the first 5-minute bar. Remember, if the first 5-minute bar is too long for your liking, but you still want the stop, use the 55% retracement rule. Go halfway. In the case of a short, go a little bit higher than halfway. And there's your 55% stop level. If the bar is too high, I really want you to really place your stop there. That's giving it the appropriate ample room. But I do understand exceptions to rules. Okay. Now, in reality, this stock dropped from 9:35 Eastern time when we shorted. Look at the arrow. And it really never truly gave us any indication to think about taking some off the table until here. Every high of each bar was lower and lower and lower and lower and lower. Every low, for the most part, was lower and lower. Not exactly every one, but still. I usually, in a downward trend, judge the highs, and an upward trend, judge the lows. And yes, you're going to get opposing colors every now and then in your trend, but opposing colors are just brief breathers. We need not concern ourselves with breathers. What we do need to concern ourselves with is change of trend. Here's a stock that is clearly not declining anymore. I hope you see this as I'm drawing this. Change of trend. Also drops away from the 20-period moving average are very significant. Deep drops below and deep rallies above, for that matter. Let's take a look at another example. Let's assume that the first 5-minute chart of the S&P 100 looks like this. And then I find a stock in that same index that has a bear elephant bar. These are not the same bars, guys, but they are the same power. You don't have to exactly match. All you have to do is ensure that I have one of the 4 power bars in my first 5 minutes of the overall market, and I have another one of my powerful 4 bars in the first 5 minutes of the stock. That's a match. We're going to short, in this case, as soon as the low of the first 5-minute chart gets violated. Once that happens, so our short happens here, we go short. Our stop goes right above the high of the first 5-minute period, limiting our loss to practically 1 bar. Okay. And you're looking for a good 10, 15, 20-minute pop. That's what we're looking for. That's what my 5 to 15-minute trader does. That averages $8,000 a day. Sometimes it's 12 or 13, sometimes it's 3 or 4, but the average is running around $8,000 a day. What he's looking for is simply one of the 4 bars on the market, first 5 minutes of trading, and one of the 4 bars on the stocks, first 5 minutes of trading. And he's looking for just that first 10 to 20-minute pop. And he often will have 3 or 4 5-minute plays going on simultaneously. What you'll find is that you're going to find 3, 4, 5 of these stocks within the first 5 minutes of trading. Wow, okay, the market has a topping tail bar. Now here, WXYZ has a bear elephant bar in the first 5 minutes of trading. It's almost finished. Oh, this one has a topping tail bar in the first 5 minutes of trading. That first 5 minutes of trading is almost finished trading. Oh, wait a minute, look at this. This one has a red elephant topping tail bar. This one I just found has a green topping tail bar. And this one has a fat, giant red elephant bar. Maybe I'll take them all. And usually not at the same moment. Sometimes at the same moment. But usually one triggers, boom, here's a stock that just broke above the low of the first 5 minutes of period. Let me short 1,000 shares. 2 minutes later, oh, my second one that I was looking at just violated the low of the first 5 minutes of trading. Let me put another 1,000 shares on the line in this one. And then maybe 20 minutes later, another one hits that was on your initial list. And sometimes they all happen simultaneously. Sometimes they trigger at the same time. And you might have to take 2 or 3 almost back to back. Sell, 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 sell. Or buy, 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 buy. And if you just simply do better, trading one position at a time, then you have your hands full. You'll just simply have to, I have 5 potential plays, and maybe you just say the first one that triggers is mine, and then the rest I discard. Anything random like that is cool. Or maybe you say, of the 5 potential ones that I have, I'm only going to do the exact matches. The market has a topping tail. I want the one where the stock has a topping tail too. I want a perfect match. I'm hoping this is making sense as we go along. Okay. I am accustomed to hundreds of questions coming by. So when I'm in a presentation where I see none, only because I know our operators are answering them as I'm speaking, it's still a little weird for me, to be honest with you, right? Some of your questions help me to direct the flow of information. So when I don't get that, I have to assume that the
Oliver,
flow is good. Yes.
I can translate them to you and write you on the personal chat.
No, absolutely. I would love that. I'd love that.
Okay, I'll try to do that.
Okay, fantastic. Okay, let's take a look at another example here. I want you to assume in this case that your overall market in the first 5 minutes of trading has produced a topping tail, no color topping tail. And you have found a stock in that same index with one of the 4 bearish bars, an elephant bar or one of the 3 variations of a topping tail bar. In this case, there's an elephant bar. Remember, you don't need an exact match. All you need is one of the 4 bars in one and one of the 4 bars in the other. One of the 4 bars in the market's first 5 minutes of trading and one of the 4 bars in the stock's first 5 minutes of trading. That is what we call a match. Once that 5-minute low gets violated, in this case, we immediately put a stop right above the high of the first 5 minutes of trading. And then we let this thing we relax and trust in the power of follow-through. You can trail a 20-period moving average stop if you like. But remember, after 2 bars of profitability, you move that initial stop to break even. Once you're at break even, you can truly breathe easy now. The worst case scenario is that you're at or close to break even when you eliminate, if you get eliminated. And this is the moment we want. This is what we're really after. We're really after just grabbing trades with the hope that they get to break even status very quickly. And the best of all traders here, they get 4 or 5 stocks that trigger maybe in the first 15 or 20 minutes of the trading day. Maybe there's 2 at the same time and another one follows a couple minutes later. That's 3 that they're in. And maybe 5 minutes later, another one happens. That's 4 that they're in. 10 minutes later, the last one happens. That's 5 that they're in. So they've got 5 individual longs. Right? 5 individual longs. And maybe one gets stopped out. Another gets stopped out at break even. And the rest turn up to be winners. One winner's 3 bars. One winner's 12 bars. Another winner's 6 bars. That's a very profitable day. It's not easy to trade only. Is it not easier to trade only the index than finding the stocks with same bars? There are traders that just trade the index with this approach. So when the index gives them a bull elephant bar, they trade above the high of the first elephant bar. If the index gives them a bottoming tail bar, they trade above the high. Yes, there are traders who do that and keep it very simple. But there's a cost for that. As you know, the overall index is a collection, an average of all the stocks, not only the ones up, but the ones down too. Now think about this. If you focus on the stocks that are purely up, where the average is averaging all the stocks up and the ones down, you can zero in on stocks that have the potential to run further and bigger than the overall market does. So I've always leaned toward doing it with the individual stock approach because I believe in my ability to, if the stock market is strong and it's incorporating losing stocks too, then I'm going to go to what's purely strong, and these purely strong should actually outrun or outperform the market. I want to beat the market, not be the market. I hope that makes sense. I want to beat the market, not be the market. All right? But good, great questions, oh guys, great questions. I love them. I love questions. Questions mean you're thinking. Questions mean something's happening inside of you. A person who's dead doesn't ask questions, or a person who's asleep is not even getting anything doesn't ask questions. A person who's alive and vibrant, who's thinking about it, rolling it around, analyzing it, playing with it, pondering it, making it yours, that's when question. Positions, no take criteria earlier. When are you taking your first profit? Take profits on any multi-bar rally. So I'm going to call that 3 to 5 bar rally. If you get three consecutive profitable bars after your entry, so you enter and then the next bar is up, the next bar is up, the next bar is up, take some profits. Or if you want to hold on a little bit, definitely take some profits into the 4th up bar, the 5th up bar. Because on an intraday basis, your stock is now extended and due for a pullback after 3 to 5 consecutive up bars. Or use a trailing stop if you like. But if you get to break even, what I have found statistically, now listen to me carefully, what I have found statistically is that if you sell half versus everything with a break-even stop, you're going to make far more money than the trader who takes off the whole trade after several bars up. Oh, I'm nicely profitable, let me get out. Because on the second half with a break-even stop, you can go to lunch, you can pick up your kids from school, you can have a conversation with a friend, you can watch your favorite television program and not be worried. Your stop is at break-even. And let's see if this is one of the days that gives me my home run. Let's see if this is one of the days where the stock that I've chosen just moves in my direction all day long. And just by virtue of mathematics, you get that. Mathematics shines like the sun on the just, the unjust, those that are worthy, those that are not worthy, those that are good, those that are bad, those that are tall, those that are short. You are going to get your fair share of stocks that after you buy them, after that first 5-minute breakout above the high, you're going to have your share of stocks that run the whole day or most of the day or half the day. Everyone gets their fair share of those. It's just mathematical law, like flipping a coin. Long enough, I get half heads and half tails. And remember, this math works in your favor because whenever the stocks don't do the right thing, we cut them off after 1 bar. But whenever they do the right thing, we don't cut them off. We take half off. Yes, I've always taught my children, my traders, which I consider my children. I tell my traders, always take some off the table for the kids. Always be almost an immediate gratification taker. This will make you confident. I just grabbed some profits out of this initial trade. Now let me see if with the remaining amount I can create wealth. So I combine income, grab your income, but on half. And let's see if we can create wealth with the second half. And that's a wealth/income approach to trading. Okay, so don't forget that you are taking some profits. Oliver, even on, oh wait a minute, let me see here. Some questions here. I like these. Another question, is it better 5-minute time frame than the 15-minute, or depends how comfortable you are with it? All right, listen, if the 5-minute proves, I like the 5-minute chart with equities. If that proves too fast for you, do the 15-minute chart. But remember, if you do the 15-minute chart, you have to play smaller because your 15-minute bars are going to be bigger and your stops are going to be further away, right? So you can play the 5-minute more aggressively. Now, some people say, Oliver, can I do this on the 1-minute or the 2-minute? Yes, you can, but only on big 1 or 2-minute moves. There are days when stocks or the overall market moves big in the first 2 minutes of trading. Then, of course, use the 2-minute then. Because sometimes waiting for the 5-minute, then it's just going to be later. But if your first 1 or 2 minutes is tiny, then don't use the smaller time frames. Now, there are a lot of nuances I can go into with this, but we don't have the time for that. So I do want to keep it basically, I want to keep it basic so you have the foundation and you can come up with your own variations of this. All right, nothing's set in stone, but you should have a firm foundation in place. All right. Now let's move on here. Other real 5-minute examples. Real 5-minute examples here. Hold on just a second. Okay, let's assume that in this case, your overall market has a 5-minute bar or 2-minute bar. If your 2-minute bar looks like this, then you can trade off the 2-minute chart. So as you're watching the first 5 minutes, you're going to know if your 2-minute looks really, really strong, or it's kinda not sure, and then you have to wait the 5 minutes. If you go to the 15-minute time frame, understand you're playing a bigger time frame, you have to make adjustments. You have to play smaller, your stops are bigger, and it's not the first 20 minutes of trading, it's the first hour to hour and a half or so. All right? Let's assume that your first 5 minutes of trading and your overall market looks like a bull elephant bar. Here you find a stock that's also a bull elephant bar. Now you're saying, okay, my stock matches the market. I've got all rivers in alignment moving toward the ocean. I'm going to buy it once it trades above the high. Okay. Now I can take this I wish I could take this moment to talk to you about stopping out and so forth and so on, but that's just another talk at this point. But in this case, we didn't get a tremendous amount of upside, but certainly enough to make some profitability. The beauty of this approach is that you're always, when you lose, you're only going to lose the first 5-minute bar. But when you win, you might win all day long. Notice how once we bought above the high of the first 5-minute bar, we put an immediate stop under the first 5-minute bar's low. We got our 20 to 30-minute move to the upside. Our stop is now break even. We sold 1/2 on the way up here. Now our stop is break even. The worst we can do is to make money only on the half and to break even on the remaining half. But we're going to let this thing have all the room it wants and see where it goes. And every now and then you're just going to get that stop that runs all day long. But you will never be in a stock that runs all day long negative to you. You will occasionally get a stock that runs into profitable territory all day long, but you will never be in a stock that runs contrary to your position all day long while you're losing money all day long. You'll only lose 1 bar. But when you win, you potentially can win all day long, and you can potentially win in the first 20 minutes. You can potentially win for hours, but you will never lose more than one bar. And if there's one thing you leave here with, please leave here with that. What if you could just, every single loss you ever experienced was limited to one bar? Mathematics would take care of you on the win side. You could throw a dart and pick a winner every now and then that runs all day or runs for hours. Many traders don't understand this, but your job is not to find winners. Winners flower and materialize and nurture and grow and manifest all by themselves. What doesn't manifest by themselves is small losses. You have to work at becoming a small loss taker. You do not have to work at becoming a winning finder. 50% are going to be wins and 50% are not. That's the law of math. But what do you do with your losses, not your wins? Winners take care of themselves. Losses do not take care of themselves. Your job is to be a great loss taker. I hope this is coming through in a very, very powerful way for you. There are many novice traders out there. I've been at this for 25 years teaching traders, and I know this. They're looking in the wrong direction. They're out searching and reading books and reading articles and going to seminars and searching for how to win when really they should be learning how to lose. Winners take care of themselves. You luck into your winners. You do not luck into small losses. Okay. Oliver, even in 1 minute bars, does it make sense to close your positions on the third to fifth bar? Yes, it does. But remember, when you're using the 3 to 5 or maybe 8 bar, I use Fibonacci numbers 3, 5, 8. When you're running consecutive bar wins and you take some off the table, what are you taking? You're taking a small but satisfying gain of half. Now what are you doing with the other half? Trying to go for the big win with a break-even stop. And when you combine these two things, guys, ladies and gentlemen, when you combine the urge to snatch a quick profit with the urge to get a big win, now you're playing right. Listen, for years I battled with trying to, my problem was I snatched at my profits too early. I was a very consistent trader in the early days, but my problem was how I would snatch at my profits early only to watch the profits be much bigger if I just held on in many occasions. So I battled with this. I struggled with this. I did every exercise. I tried every approach to try to not snatch at my profits early, and I couldn't. It was part of my nature. So I was trying to go against my nature as a human being and as a trader. So then I came with this concept, this idea. What if I not try to solve this? What if I not try to call it a problem and try to solve it versus use it? It's a good thing. And so then I said, well, wait a minute. If I had these two urges, the urge to snatch at profits early, and also I had this urge to make a big win. So I had two urges. Why not feed both of them? Why not satisfy both urges instead of trying to choose which urge I want to give my allegiance to? So I began to say, I'll sell half of my position to satisfy the urge of wanting a profit quickly. And then I will let the other half with a break-even stop try to satisfy my urge of big profitability. And so my two demons became two angels just with a subtle shift in my thinking.
They're not demons. Why fight them? They're angels. Why not feed them, support them? And now they're the two biggest friends I have. They work together in unison. Oliver, what's the best way to identify an inversion? Not sure what you mean by that. I need some more clarification with that. Remember, you have your stop in place. Some of your plays are going to stop you out and you're going to lose, but you're going to lose one bar. 1 5-minute bar, that's it. Some stocks are going to stop you out at break even. You were profitable, but they come back in and you break even, so you scratch those. We call that in the U.S. scratches. Scratches are break evens. Some stocks are going to stop you out with small profitability. Some stocks are going to run all day long, and they're going to be the best days of your life. And everyone gets them. Everyone has their fair share of those. If you really stay diligent at stopping out on that first 5-minute bar, the market is going to take care of the profit side. Trust me. Think about this. Think for a moment. I want you to get into a contemplative mood for a minute and think this. If a stock that you buy at $20 runs to $24, $4 gain, what did you do? I mean, I know you bought it, but a lot of people bought it. But what did you do to contribute to the $4 gain? Except pray or hope or wish. You did nothing. But when I see a trader who can show me his trading record, and I only want to look at your losses, I have no interest in your winning trades. You want to show me your trading record? I have no interest in your winning trades. Show me your losing trades. Show me your losing. If a trader shows me his losing trades, I can show you what kind of trader that is. No one can show me what kind of trader there is with their winning trades. You luck into your winners. Oh, the rising tide raised all the boats and you want to show me your winners? Oh, that was very easy. The market was going up. Everything was going up. You could have fell into the market and made money. That doesn't show me anything. But what you can't do is mistakenly show me consistently small losses. That takes skill. There's a seasoning there. There's a power that is evolved in that type of trader. That takes practice. That takes enlightenment. That trader's flowered into something. So when I look at a trader's losses and I see consistently little losses every single time, I know if that trader's not profitable, I can easily make him profitable. All I got to do is tweak a few things on the other side and the winners start to flow. The market takes care of winners. You don't do anything for a win. Some traders say, well, Oliver, don't I buy correctly? Well, yeah, theoretically. But let's assume that everyone is on equal footing on buys. Everyone buys the same. Those who cut their losses fast versus those who don't, I guarantee you they're the profitable ones. And the ones who don't cut their losses fast are the big money losers. It's not the wins that make you successful. It's how you handle your losses that make you successful. The market's going to give you 50% wins and 50% losses. I know this is a blow to some people's ego, but it's true. What if I enter the market later on? Will this methodology still work? It has a power in the first 5 minutes that it does not possess in other periods of the day. All right? The first 5 minutes is special because there's pent-up demand or pent-up supply. This is what creates your follow-through. It's the angst or the anxiety to hit the market at the open by institutions and big players that we're playing off of that theme. As the market kind of gets into its flow, you lose that pent-up demand or supply that can create that jolt that we're looking to initially take advantage of in the first 20 minutes of trading. So we have other tactics and things that we begin to put into play after this period. So we play the first 20 to 30 minutes this way. We play the rest of that first 90-minute period another way. We usually take a break in the middle of the day, and then we come back in full force and use other tactics that are appropriate for the latter part of the day. You can't be a one-dimensional trader in this game. Not today. And 30, 40, 50 years ago, maybe. But today, you have to have a multi-dimensional approach to the market because the market has different moods, just like a human being. Sometimes it's happy, sometimes it's sad, sometimes it's melancholic, sometimes it's confused, sometimes it's sleeping, sometimes it's jumping up like a Mexican jumping bean. You have to have a method for each one that matches each one of its moods. And you have to be able to identify, okay, the market's in a happy mood. Now let me take my happy strategy. Happy strategy matches happy mood, odds go up of success. But when you are playing a market that is in a happy mood and you have a tactic that is more appropriate for a sad mood or an angry mood, you're going to have trouble. And if you just have one approach to the market, you're going to be like a broken clock that's right like kind of once or twice a day. But in the trading, it's a once or twice a month. See, the clock in the market runs on a monthly basis. Oliver, it happens to me almost occasionally, entering a trade, and it pulls against me. I don't know if it's a correction or a reversal. Interesting question. I like this. And many times I get out of the trade at the 61% fib number and the Fibonacci number, and when it almost touches the top of that elephant bar and then continues to lose money. Okay. You are making this far more difficult than it has to be, I'm afraid. Here's the fallacy in your thinking that you have to know. Your fallacy is, as many traders' fallacy is, that you have to know something. You don't have to know anything. You just have to act when something happens. But you do not have to know when that something happens. Here's my point. You're in a trade, like you said, and it pulls against me, and you say, I don't know if it's a correction or reversal. Who cares if it's a correction or reversal? If it's a reversal, isn't your stop in place, and doesn't that take care of itself? Why are you involved with this? Why are you agonizing? Why is the market playing you versus you playing the market? You have entered the trade. You have placed your stop. Your job is over. Sit back and relax. If it's a correction, your stop's not going to be hit. If it's a reversal, your stop's going to be hit. Both are successes. Listen, don't interpret a stop out as a failed trade. A stop out is a winning trade. It's a successful trade. You drew a line in the sand and you did what you promised yourself you would do, which is eliminate the stock if it went to this level. Congratulate yourselves. In order to build this mindset that stop outs are successes, I often have days where I reward my traders for losses. That's right, losses. But we define the losses. So I have drills like this. I want every trader today to lose exactly on one trade, exactly 17 cents. And any trader who loses 17 cents on any given trade, exactly, not 16, not 15, not 20, but 17 cents, I'm going to deposit in their account 50 cents. I have drills like that. Now, all of a sudden, their focus is, well, let me find a losing trade. But let me find exactly a losing trade, and let me try to eliminate it exactly at 17 cents. I change the paradigm. I shake them up a little bit. Sometimes you can get a little stale in your thinking, in your approach, and you need to be shaken a little bit. Break out of these well-entrenched modes that you get into. But listen, if you know where to enter above the 5-minute high, if you know where to place your stop just a little bit below the first 5-minute low, that's easy. Now your job is done. Now it's not even your decision what to do next. In a sense, it's the market's decision. The market's either going to deliver you profits, or it's going to deliver you a loss. Or if it gives you the first 2-minute rise, the first 2-bar rise, you move your stop to break even. Now the market's either going to give you profits or break you even. Your job is very small. The market's job is big. And in a sense, it's almost as if you are the master and the market is the servant. So your attitude should be not, oh, I hope the market treats me well with this trade. No, your approach should be, okay, I have chosen to buy above the 5-minute high of this, and I have chosen to place my stop here. Now, Mr. Market, you either make me money or you get eliminated. That's the attitude of a winning trader, not, wait a minute, I entered and I hope this one's a winner. Oh, please, oh God, I hope this. No, that's the attitude of the market playing you. You're the servant and the market's the master. No, you're the master and the market's the servant. The market must play by your rules. Your rule is, I buy above the first 5-minute high on strong days. I place my stop under the low of the first 5-minute bar, and now the market must play by my rules. If it doesn't play by my rules, it gets its head cut off. Period. And the market says, okay, I better play by his rules. I know it sounds philosophical, but it makes a big difference. Hi, Oliver, these strategies results for Forex and commodities market, in any market that human beings trade. These things are human being induced. The market can't move up or down without the interaction of human beings, which are driven by fear and greed. So all of these movements are basically the pictures of fear and greed. And fear and greed exist in all markets. Human beings trade in all markets. Now, the moment you can tell me that, wait a minute, Oliver, on this market, Martians from the planet Mars play this market. Well, I don't know how Martians' emotional status is made up of. I do know human beings are driven by fear and greed, and because they're driven by fear and greed, whatever human beings will trade will follow one giant pattern, the bell-shaped curve. It'll go up, greed, top out, and then it'll go down and then repeat itself. It'll go up, greed, top out, and then go down, fear, and then repeat itself. Now, sometimes it does it real fast. Sometimes it does it over time. Goes up, 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 and then down really fast. Or sometimes it goes up really fast, up, 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 and then down, 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 much slower. So it goes up at different velocities and down at different velocities, but the bell-shaped curve, the boom-bust cycle, is the picture of the vacillation between fear and greed, and that will exist in every market. So what we're doing is isolating when greed hits the market at the open. We're using the first 5 minutes as a filter Does fear hit the market in the first 5 minutes, or does greed hit the market in the first 5 minutes? And you have the 4 bars that gives you the answer. If the first 5 minute bar is an elephant bar, then greed has hit the first 5 minutes. Greed is coming to the market at the open. If a nice strong bottoming tail bar, a green one or a red one or no color, has hit the first 5 minutes, then greed is the way you bet. If the first 5 minutes is a bear elephant bar, giant red one, or a nice topping tail one, then fear has hit the market at the open, and that's how you bet. I can't make it any simpler than this. I'm not saying it's easy. I am saying it's simple. Okay? And I often tell a story about this. I have twin girls. They are 7 now. January they'll be 8. And I remember when they were 3 years old, they were in absolute love with Nemo, the movie Nemo. I mean, we literally watched Nemo like 7 times a day, all day long, basically. It was on the TV all day long. And there was a local carnival that came to town, and there was this booth at the carnival that had this Nemo hanging from the ceiling, a stuffed animal Nemo. And oh my goodness, my little 3-year-olds, they just, in tandem, just had a tantrum and started crying. We just had to get this Nemo. So I go over to the booth and I ask the gentleman at the booth, I say, listen, what does it take for me to win this Nemo here? My girls are crying, they want the Nemo. And the guy says, listen, all you have to do is put one of these balls in that basket right there. And I says, wait a minute, that basket, are you sure? That basket's only 2 feet in front of me. Are you sure? He's like, yes, sir. And I says, well, but how many tries do I get? And the guy says, you get 3 tries. And I says, well, I got to get all 3 of them in the basket? And he says, no, all you have to do is get 1 of the 3 in the basket. And I said, well, how much do I have to pay you for a try of 3? And he says, $5. And I gave him $5. And right before my first pitch, I said, you sure? All I got to get is 1 of these in that basket, and I get that Nemo for my girls. He says, yes, sir. $455 later, I am walking out of the carnival angry with this not even that big of a Nemo. $455. Simple. Put this ball in that basket 2 feet away, but not easy. So I am saying, I use that example all the time. I am saying, and if you go to my Facebook page, you will see this Nemo. I carry this Nemo with me at all times as a reminder of that life lesson. But listen, I am constantly telling you that this is a very, very simple approach. It's not easy when the bars are moving and you're listening to Jim Cramer on CNBC talk his nonsense, and there's an FOMC meeting coming in the next several hours, and you know, earnings and IBM's going to be introduced in the next 2 hours, and you know, all of this noise is confusing you, when all you really, really have to do is match a stock with the market so that you have all power in the same direction, not playing a stock against the market or not playing the market against the stock. You're playing everything in the same direction. You're buying above the first 5-minute high on strong days. You're shorting below the first 5-minute low on weak days. You're placing your stop based on the low or the high of the first 5-minute bar, limiting your losses to 1 bar, taking half your profits off, moving your stop from under the low, from moving your initial stop to break even after 2 bars of profitability, and then taking profits after 3 to 5 bars of profitability on half, and then keeping the half with your break-even stop to see how far it goes. What if you wrote those simple rules out? How basic is that? But the question is, can you do it time and time again the same way? That's the question. Oliver, how similar in terms of impulsive movements and psychology of masses that you were talking some minutes ago, is it with the Elliott theory? No, there's no Elliott theory. I mean, listen, there are truths, there are small truths. There's reality or small bits of reality in all the theories. I have not, in my experience, found a theory that has presented itself as the Holy Grail and this is the only one I need. So there are elements of Elliott theory that I love, and there are elements that I hate, just like every other method. But I want you to understand that these methods are training wheels for you. That the actualized trader, the enlightened trader, the trader who gets to the point of almost what we call in the States as being in the zone, being at one with the market. When you are at one with the market, when you truly arrive as a true, successful, enlightened trader, you don't have methods. You don't have theories. You just are at one with the market. Like, for instance, I don't know if many of you were familiar with Michael Jordan. I think you probably were. One of the greatest sports figures of all time, basketball player. When he came down the court, he wasn't thinking a theory. When he had the ball and was dribbling down from his opponent's area, well, from his area to his opponent's area to try to get a basket or whatever, to pass it off, he wasn't thinking of formula. He wasn't thinking rules. Okay, I've got to put my right foot in front of my left foot, and then I've got to move 90 degrees to the left, and then I've got to shift to my right foot, and then I've got to back up, and then I've got to look left. No, there was no theory. At that point, it's art. There's a point. See, these theories, these rules are training wheels until you get to the point where you're just simply at one with whatever is happening at the market, in the market. And you spontaneously respond to whatever's going on. Just like Michael Jordan spontaneously responded to what the opposing team was doing at the time, what his individual opponent was at, his position or whatever, and it just spontaneously happened. He wasn't thinking it. And so the point I just want to make is that no, it's not based on Elliott theory. I mean, if you had to pick one theory that a lot of things that I do is based on, I do base a lot of things on Fibonacci theory. And even that eventually goes. So someone said, well, Oliver, why did you sell on the fourth bar versus the third bar or the fifth bar? That's not Fibonacci, because it just felt right. Why didn't you wait for the fifth bar? That's the Fibonacci bar. Well, because I just felt that the selling on the fourth bar was right. I hope that makes sense. I hope it does. Wow, here's a long one. Oliver, let me see. Oliver, I realized that in DAX happened something curious. As you know, the DAX closes at, right, 1600 hours and 30 minutes, of course, and reopens at 8 hours at GMT in the next day. I realized that if the price of DAX at 8 is at least 30 points higher than the previous price close at 1630, more than 70% chance that DAX goes up the next day, the next 2 minutes. Wow. Okay. Between 8 and 8 hours, it will go higher. Same happens if the DAX at 8. So simple. So why don't you just have? So why this doesn't happen with Dow Jones too? Do you know any patterns like this in the? No, I am very, very, very much unaware of precise patterns like that. And I'm, with no disrespect, I'm willing to bet this pattern is probably not as accurate as you might be thinking it to be at this particular point. What I'm going to say is this. What you will find to be accurate in a certain specific time frame is going to change. What we can count on is change in the market. Even though the market really continues to repeat the same bell-shaped curve pattern, it does it in an infinite number of ways. And so one of the things we can count on is change. And this is what makes the game so challenging. What we need to come up with is a broad enough approach like this, a basic enough. If your approach is too specific, you're going to run into trouble because it's specific to what? This moment in time in the market, and that moment in time is going to change, and your specific approach is going to mean nothing there. But you have to come up with a broader enough approach to where it covers so many other types of market environments that you're okay applying this almost all the time. If you get too specific, and this is what I'm sensing in your approach here, that is too specific to me because that's going to change. If it's accurate right now, it's going to change, trust me. But if you're broad enough to cover a variety of different occurrences and different patterns and different tendencies, and your set of rules in the beginning promotes proper action, like rules like every time I lose it's 1 bar, but on average when I win it's 8 bars, 6 bars, 13 bars, 22 bars, even 4 bars, but I only lose 1 bar. When your rules coerce you to act appropriately according to the laws of mathematics like that, you can't get into trouble over time. You just can't. You can't get into trouble losing only 1 bar on every single losing trade. It's impossible because just the law of math will give you 8 bars or 13 bars every now and then. That's just mathematical law. All right? So no, but interesting questions, guys. I'm glad in this session we've decided to take a look at some of these things because, as I said, you know, you guys kind of dictate what type of market environment we have. One last example I want to give you guys. One last example and we are done. All right? And I am open for more questions if you have them. Let's assume that the first 5 minutes of your overall market is a nice solid green bottoming tail bar. Wow, nice. Then you find a stock in the same index that looks identical. First 5 minutes of the bar, bottoming tail bar. Now all you need to do is if the high of that first 5 minute bar is taken out, you buy. You immediately place your stop under that first 5 minute bar's low. Once you get 2 bars of profitability, we move the stock to break even. So once you're in profits twice, once 1 bar closes you profitable, and then the next bar, another bar closes you profitable, doesn't have to be the next one, but then you get a bar that closes you even higher than the first profitable bar. Now move to break even. After a several bar run within the first 20 or 30 minutes, take half off the table. Okay, so here, take half off the table somewhere during this period. And then let the other half with your break-even stop. Oh, sorry. Let the other half run. And as you can see in this case, it ran all day long. And you're going to get your share of those. All right? Any other questions? Is it easier if we're going to close a gap? Is it easier if we're going to close a gap? Let's see. So what I think what you're asking is, let's say there's a former gap above the current price, and the stock opens today strong with a nice one of those 4 strong bars, and the market has one of those 4 strong bars, and there's a prior gap above. Will it be easier because the stock has a tendency to fill gaps. So will that scenario be easier for it to move to the upside? Probably. Yes, you can bring your other knowledge into this. Let's say there's an overhead 200 period moving average that's not that far away, and it's a flat 200 simple period moving average above. And you get this strong bar that says buy above the first 5-minute high. But there's that flat 200 not too far above that. Then maybe that's when you miss. Yes, there are other things to incorporate into this. Sure. It's important to look, is it important to look to match between the market and the stock, or look for the beginning of the market is enough? I don't quite understand that question exactly, but let me just comment about some of the things you're mentioning here. You initially asked the question, is it important to match the stock with the market? I believe it is. Now, I believe that the best odds are when the market's strong and your stock is strong versus the market's weak and your stock is strong. Because if the market continues to be weak, it could cause your buyers to stop buying because the overall market's weak and to step back, and now your stock is no longer strong. Strong market, strong stock, power, one directional power. Strong, weak market, weak stock, strong directional power. Strong stock, weak market, odds less. Strong market, weak stock, odds less. Okay? That doesn't mean that you can't find winners that way. So with that being said, I will say this. Some traders ask, well, Oliver, what if the overall market is flat, but I find some stocks with some powerful first 5-minute bars? Can I play them? Yes. You can play anything you want to as long as you do what? Stop out on the first 5-minute bar if you're wrong. I tell my traders, if when in doubt, I actually want you in. So some traders say, well, Oliver, listen, I don't know quite whether I should take this trade or not because it isn't. I interrupt and take it. We can't make money talking about it, right? So let's just get in it. What's the worst case scenario? You lose the first 5-minute bar. What's the big deal? We can make that back easily. I would rather my traders in than out, thinking about it, pontificating, guessing, debating, writing theses on it, having monologues and individual lectures on whether they should get in or out. To me, that's just a loser. When in doubt, get in. If you're disciplined enough to get out on the first 5-minute bar, what's the worst that can happen? At least you give yourself a chance to make money. On the sidelines thinking about it, you're not going to make money. You're not going to make money thinking. Guys, listen, I am a disrespecter of thought. I know there's a movement out there that says thought is powerful, and the power of thinking and think positive and this and that. I say thinking is our problem. Thinking is your problem. You can think yourself out of winning trades. You can think yourself into losing trades. But thinking means that you are confused. As an example, you don't have to think that this is a telephone. Wait a minute. Is this a telephone? Wait, let me figure that out. Let me call my friend and let's have a debate over this. Is this phone on my wall, is that really a telephone? Is this really my cell phone? You don't have to think when you know. Thinking comes into your life, or thinking manifests when you don't know. And when you don't know, you are confused. And when you are confused, you make bad decisions. Okay, when you know, there's no thinking. I'm a disrespecter of thought. Thought is our problem. And your goal as a trader is to get to the point where you don't think. How many times have we talked about sports figures that get in the zone? They are not thinking. Michael Jordan's not thinking when he comes down to the court, really. He's just reacting. Action, thinking is the impediment of action. So I break up this thinking thing with my trader by saying, Oliver, I'm thinking about, no, buy it. Just get in. Just get in. Let's see what happens. All right, put your stop under the first 5-minute level. Okay. Now, let the market do its thing. Relax, sit back, take it easy. It's not even your decision anymore. The market, it's in the market's hands. And if we lose, we can blame it on the market, not you. You did the right thing. I hope this point comes through clearly. I hope you've enjoyed this presentation. I will tell you that I encourage that you watch the market for a few days using this approach. Paper trade it, if you will, and then start dabbling with it in your real accounts. Track, isolate, copy, take pictures of the strong 5-minute first bars, elephants and tails, and see how many of them follow through and would have given you a profit in the first 20 minutes or so trading. Follow the ones that open up weak, strong red 5-minute bars or strong topping tail bars in the first 5 minutes, and watch how many follow through and would have given you nice profits in the first 20 minutes or so of trading. And then take snapshots or pictures of the ones where, wow, look at this stock broke above the first 5-minute elephant bar and never stopped all the way into the close. Capture those. I find that this exercise creates a stronger belief in the approach so that when it happens, you don't think, you just do. That is where we need to get. Oliver, if after the first 5 minutes the stock price hits the stop point, you suggest another entry point during the day? Well, that's another seminar. But yes, there's potentially another play with that stock. Especially if after you have, let's say after you've entered the stock, it now stops you out and goes down for 20 minutes, let's say. There's a potential buy point down there after the 20-minute drop. But that's a different tactic, a different seminar, a different approach. So I want you to understand what we do. We slice the market up into different phases, and then we have specific approaches for each one of those phases. So the first 20 minutes is this. This is what we're focused on. Then after the first 20 minutes, something else comes into play. And maybe that's the next hour, hour and a half, 2 hours. The middle of the day, you know, we're skeptical of. And then toward the latter part of the day, something else comes into play. So we slice the market up into these phases. The market on occasion stays happy all day, or stays sad all day, or stays angry all day, or stays melancholy all day. But those are not very, they don't happen every day. The market usually goes through like human beings, like you are rarely happy all day. You are happy at some point, then something pisses you off and now you're not happy, or you know, your kids do something wrong and you're upset, and you know, they're upset, and you know, your wife embarrasses you, or whatever. I mean, you go through a lot of different, just the market is a reflection of human nature. The market doesn't have any intrinsic personality of its own. It doesn't have a quality of its own. It doesn't have a personality that is unique from anything else, and it's only its personality. The market is a collective reflection of the human beings that play it. A stock can't move unless human beings move it. So the very movement of a stock is the movement of human nature at play. And when you start to approach the market this way, a lot of the nonsense that these people on TV talk about start to drop away. And you start to focus and look at the market from a purer, cleaner, more enlightened point of view. Right? And then common sense starts to really flower, powerful common sense, which, by the way, is not all that common. Common sense such as, if a stock has gone straight up for 5 days in a row, let's say, or 8 days in a row, I mean big, straight up, everyone who owns the stock is profitable. So if everyone's profitable, what's next? Profit taking. And if everyone's profitable and everyone's a future profit taker, what are we in store for? A normal drop? No, when everyone's profitable, you get an abnormal drop because everyone becomes a profit taker. So, I mean, when you start to look at the markets purely this way, this powerful common sense starts to emerge, and things start to fall into place, and this game stops being the complex beast that it is. Not that it's easy, but it's simple. And that's all we can hope for. Hi, should we choose more or less volatile stocks of this kind of trade? I like the volatile ones, to be honest with you. I do. But the pocket, I don't quite know your market as well as I know mine. But I will tell you this. My sweet spot, the price range that I love to trade is $20 to $60. I love that price range. It's high enough to get some nice movement, good movement. It's low enough not to get killed, like trading Google. You follow what I'm saying? So it's that sweet spot for me. Right? And so I like volatility, but I don't like the volatility up there at $900 and stuff like that. I like that volatility at between $20 and $60. Love that price range. Okay, there's one before this. Oliver, when you say the first 5-minute bars, is the first 5-minute bars of the day? Absolutely. So if you're playing the European markets, it's that first 5 minutes of the European market. Remember, that first 5, we're playing off of pent-up demand and supply because the markets were closed. Right? And there's an explosion right at the open, one way or the other a lot of times. And that explosion oftentimes, not all the time, oftentimes has follow through. And if I had you for more time, we then begin to talk about what do you do with the trades that stop out, because there's something to do with them. All right, but we don't have time for that. But we'd start taking every piece of the market and walking our way through the day. All right? You have been phenomenal. Thank you very much for your time. Thank you for having me once again, gentlemen. It's a pleasure. I am open anytime to address your audience, should you need to. I hope this presentation has been helpful. Again, guys, I do want to show you one thing. Should anyone be interested in a full copy of this presentation, I want you to email trading@ifuntraders.com, and a PDF version of this presentation will be sent to you. And I encourage that you do that, just so that you don't let the nuances of the concept slip away from you. So just simply email trading@ifuntraders.com, and we will get a PDF version out to you within the next day or so. All right?
Thank you very much.
Okay, Oliver, thank you very much for your time. It was a pleasure to have you here for these both seminars. We hope to count with you for future seminars too.
Fantastic.
And take care. I think the clients also enjoyed it. So
Fantastic.
we'll
Thank
keep
you
in
very
touch
much.
later. And if
Thank you.
they have some kind of questions, we can send it to you. Okay.
Sure.
Thank you
Fantastic.
very much.
Thank you much.
And,
Enjoy the rest of your evening. Thank you.
okay. Thank you very much.